In today's episode, we will look at capital gains tax and explain when you need to think about it as an investor. We will also explain one of the tricks to avoid ever having to worry about it again. Keep watching to find out more. This is Capital Gains Tax Explained by The Simple Economy. Capital gains tax, or CGT, is a tax on the profits you make when you sell shares. As with most things in life, the taxman wants a slice of your profits. The first thing to note about CGT is that you only have to worry about it when you actually sell your shares and take your profit. So the value of your shares may show a profit on your valuation, but you don't have to worry about CGT until you actually press that sell button. It's also important to note that we are all given a tax-free CGT allowance each year. In the 2019-20 tax year here in the UK, the allowance is £12,000. That means that the first £12,000 of profits you realise are not liable for tax. Any realised profits over that number are. The tax rate you currently pay is 10% for basic rate taxpayers. So let's explain CGT with a couple of examples. Let's go back to the valuation screen of my shares in Ben's Brollies. So I have 100 shares in the company. I bought them when the share price was £10, meaning the total purchase price for those shares was £1,000. The shares have done really well over the years, and the share price is now £200. 100 shares at £200 each gives me a current total value of £20,000. So as you can see, the shares are currently showing a profit of £19,000. So do I owe any tax at this point? The answer is no. I still haven't sold any of my shares, so I haven't actually taken any of the profit. However, let's say I do press that sell button. What happens then is the £19,000 gain has been taken, and now we must see if I owe any tax. So as we mentioned earlier, we are all given a £12,000 tax-free CGT allowance each year, meaning the first £12,000 of my gains can't be touched by the taxman. Any remaining gains over that amount, however, can be. In my case, this is the remaining £7,000. So as a basic rate taxpayer, that £7,000 would be taxed at 10%, meaning the taxman takes £700 in tax and leaves me with a total profit after tax of £18,300. So now we know what CGT is, how do we avoid having to worry about it? Well, there are a few ways, but one of the best options available for those investing some extra cash on the side is to invest within a stocks and shares ISA. A stocks and shares ISA is sheltered completely from the taxman. You may not think that is too important right now if you only have a small amount of money invested, but as your investment portfolio grows, the taxman will be keeping a close eye on your profits. By investing in a stocks and shares ISA, you can ensure that he can never get his hands on your profits, neither now nor in the future. Thank you for watching, and please do leave any questions below.